Hi all, this is Dr. J streaming live from Long Island, New York. I haven't seen you guys in a little bit. I've been extremely busy having fun. I know that's not legal, but having fun means probably not looking at the stock market too much, because that is more like work sometimes than fun. Sometimes it's fun. My title of this video is 10 Reasons 2019 Will Be a Losing/Winning Year for Stocks. Well, how can it be both a losing year and a winning year? Well, it can't, but I'm giving the 10 best reasons put forth why it could be a losing year or why it could be a winning year. And these are the 10 best reasons that I could think of, and I'm sure you can think of a lot more. But this is what I came up with, and I'm going to share with you my 10 reasons why I think the market will do terrible this year. And then I'm going to share with you 10 reasons why I think it will do great this year. Obviously, it has to do whether certain events occur or do not occur, and we'll look at it together. As always, do your own due diligence. My opinions are strictly my own and do not constitute investment advice. I tried to do this video last night. Something went wrong technically. I hope nothing goes wrong today. So let's give it a whirl. I'm going to go and close this. And I'm going to go to the you know what? I'm not going to go to, I'll share screen, but not go to the charts immediately. Share screen. And what I'll do instead is go to my list, which I didn't even bother with PowerPoint. I just have it in Word. So we'll go to Word, and let's see why the stock market will have a losing year first. Okay, 10 reasons why the stock market will have a losing year in 2019. My first reason is the Federal Reserve Bank under Powell, as you know, raised the Fed funds rate to 2.25, 2.5 in December. That was met with a lot of unhappiness by the Dow Jones Industrial Average, the NASDAQ, the S&P, the big FANG stocks. It was a lot of unhappiness with that raise. The President of the United States didn't seem too happy with that raise either. So it looked like Powell and him were on the outs, but now there's a love affair again. Now, nevertheless, Powell has given an indication that the Fed may go 2 more times during 2019, bringing the Fed funds rate up to 2.753%. So that's reason number one, judging from the reaction of the stock market to the December raise. Reason number two, bond yields will rise, giving investors an alternative to stocks. That's true. If indeed bond yields do rise, there'll be someplace else for retired folks and other people that are conservative to put their money and make some money on their money. So right now, it's still pretty low, and the stock market has been the only alternative that could keep up to inflation or surpass it. So bond yields rising will give an alternative to stocks, which is bad for stocks. Number three, Democratic control of the House coupled with Mueller indictments will cause uncertainty. Yes, the market hates uncertainty. We want to think that Donald Trump will be there forever, considering the love affair with Donald Trump on Wall Street. So Wall Street's happy with Donald Trump. Therefore, Mueller not being happy with Donald Trump, the Democrats causing waves will cause uncertainty, which is not good for the market. By the way, I'm strictly apolitical. I'm not saying that I'm a Republican or I'm a Democrat or I'm an independent or any of that stuff. I stay away from politics. I'm just stating what I think is good for the market or bad for the market. Trade wars with China and others will lead us into recession by Q4. So that's probably true if they escalate. And number 5, global slowdown will intensify, severely hurting our financial institutions and creating an environment of fear and mistrust of central banks. In other words, we could have a repeat of 2009 when I think it was Turkish banks, Cyprus banks, Greek banks, Spanish banks, all were failing, and our banks took it on the chin for investing in those central bank notes. We could have a repeat of that if things get ugly. Number 6, the stock market sell-off over the last 4 months is predicting a full-fledged recession. Well, if you believe that the market predicts 6 months in advance, and we went down 20%, and it's been really intense and volatile over the last quarter, I guess you may not be able to argue with that if you believe that. 7, we've had the longest winning streak stocks have experienced from 2009 through November 2018, so any sell-off will likely be overdone. And I definitely agree with that. Number 8, we are now in bear market territory, and bear markets usually last a couple of years. And that would include 2019, I guess. Number 9, the market leaders, Facebook, Apple, Amazon, Netflix, and Google, have led the Q4 collapse. So the lead is up or the lead is down. Number 10, the charts of the major averages at year-end look ugly, especially the weekly. That is true. So we're going to take a look at that chart. But first, I want to look at the reasons why 2019 will be a winning year for stocks. I gotta find it. Okay. While the Fed may raise twice more, pushing the discount rate up to 2.753, historically stock markets go up during the beginning of a raising cycle, and it is entirely possible the Fed will not raise at all during 2019, as recent remarks by some Fed governors have indicated, and even by Powell, who says everything is data dependent. So it's not a given that they're going to go 2 more times. Goldman Sachs said has an official call of 3 more times, which I don't think is likely. They came out with a little addendum to that official call saying the probability is 1.4, 1.6, or something like that. So somewhere between 1 and 2 times. So I'm not sure whether they're saying 3 times, 2 times, or 1 time, but economists are very good at doing that. Isn't 2 plus 2, 4 plus or minus 1 if you're an economist? Number 2, bond yields will rise, giving investors an alternative to stocks. Yeah, bond yields went sharply up in 2018, but have been coming back down based on the 10-year Treasury note. And now it's under 3 again. So it's hard to say where bond rates are going to go. There's a fair chance it will go higher, but there's a fair chance that it won't. Especially, I don't think it'll go higher if there's uncertainty in the stock market. So it's kind of like a catch-22. Number 3, Democratic control of the House coupled with Mueller indictment will cause uncertainty. Unless there is unsurmountable evidence of collusion or obstruction, Trump will likely survive the onslaught and run in 2020 for re-election. I believe that to be true. I think Donald Trump will somehow escape unscathed. Didn't he say, oh, I don't want to go into too much politics, but he did say that he could shoot someone on Fifth Avenue in plain sight and get away with it. So I think he's got a knack for survival. Number 4, trade wars with China and others will lead us into recession by Q4. This may in fact be true, but real progress is being made by Trump and Xi to come to an equitable agreement. Since it is to both men's mutual benefit to put an end to the trade wars, I believe this to be the case. If it's to my benefit and your benefit, let's shake hands, let's get it done. Both men need this agreement. It's bad for their country, it's bad for China, it's bad for the US. So it will be settled. This is Dr. J's prediction. Number 5, global slowdown does not have to include the US. Evidence the last 10 years when even during the worst meltdowns, there was a bull market somewhere. And the US has been in a bull market while most of the rest of the world was already correcting or in a bear market. So I believe this to be true. 6, the stock market sell-off over the last 4 months is sharp, but 20% corrections precede recession about 70% of the time, and the market often recovers during the recession. So even if we're in a recession, doesn't mean the market's going to go down. Markets go up very often during the recession in a recovery period. And that means in the 4 months that we've gone by and the markets collapsed, we may have formed a bottom already and spend the next year and a half coming back, something like that. And we could even be in recession. Number 7, we've had the longest winning streak stocks ever experienced from 2009 to November 2018. So any sell-off will likely be countered with money on the sidelines, waiting for a pullback to enter. You know how many people still haven't come back into the market after 09? Or maybe now they'll come back. Number 8, we are now in bear market territory, and bear markets usually last 3.1 years. That's just an average, but often just a matter of months before making a bottom, which I think I mentioned earlier. Also, it isn't clear that we are in a bear market because some define a bear market as not only being a 20% correction, but having to remain 20% or below for a period of 2 months. I have a different definition, but I'm not going to get into that now. To me, a bear market is just a series of two lower highs and 2 lower lows. But that's a very technical definition, I think. Most people agree with the 20% number. Number 9, market leaders Facebook, Apple, Amazon, Netflix, and Google have led the Q4 collapse. But many analysts today think they are a steal at these levels. Of course, Apple, with its bad news after the close yesterday, went down to, I believe, the lows of the year, and it's getting to be really tempting even for Dr. J to get back in. Number 10, charts of the major averages at year-end look great, especially the daily, just the opposite of the weekly. So now we're on cue to look at the chart. So let's take a look at the chart of the Dow. Maybe if I minimize this guy, come on. Mouse is not cooperating. There we go. So there's the Dow right here. All right, one more click, full screen. We'll look at the weekly, we'll look at the daily. It doesn't matter what we look at first. The Dow is not having a good day today. Disregard that. Okay, so if we look at the daily, we see that the biggest green candle in the history of the Dow was put in last Wednesday after Christmas, right? That went up 1,100 points. That's the biggest move ever. that has to have significance. I mean, a big green candle at the end of a rally, that's significant. So obviously it also engulfed, well, I don't know if it's true engulfing, but it seems to have engulfed, well, maybe not. Let's forget about the engulfing part because the body is not totally engulfed. But it is a tremendous green candle. And usually the midpoint of that green candle will be retested before moving up. And sure enough, the next day on Thursday, it was retested, passed the test, started moving up. Today we have a little pullback on bad news on Apple, but that may not mean much. We could easily finish the week strong tomorrow and make back every dime that we lost today. So I'm not panicking. We may even retest this midpoint, which was, let's see, what was the low on Thursday? 22,267. So if we do, we do. So a 600-point drop, when we bounce off that and start going up, I can live with that. And we don't have to retest it. I'm just saying, I think this is a very strong support. Where we close on Thursday is extremely strong support below for the Dow. All right, so that's a positive. But now let's look at the weekly for the very same index, the Dow. 1 week. Here we have a different picture, right? We have a picture of 1, 2, 3, 4 weeks in a row, adherence to a very, very sharp downward trend line. So over the last 4 weeks, we've had a collapsing Dow. This is the first week where we get away from the trend line, and we're off to a good start, but today we're giving back. If we continue to give back, I doubt that we hit the trend line, but we're going to come closer to it again. In any event, even this terrible looking chart is looking more hopeful with this green candle here. And if this turns green on Friday, that would be wonderful. But even if it doesn't, at least we're off that negative trend line. So while the weekly looks pretty doggone awful, and there's a series of 1, 2, 3, 4 lower lows and 4 lower highs. It's not good, it's not pretty, but it's showing signs. Even the weekly this week is showing signs of turning it around. So the chart is not as bad as it looked on December 31st. It's looking a little better today. So when I first prepared this, the weekly looked much worse. It's looking a little bit better, even with this 500-point move down and in the middle of at 10:12 a.m. I doubt that we're going to close down this high. I have a feeling that we won't. I have a feeling that we probably will close. Not particularly good at guessing the close, but I'm going to guess that we'll get back half of that 500-point decline, closing somewhere around 250 points down on the day. I don't think we get it all back. The Apple news was difficult to digest. So that's where we are. I think there are 10 good reasons you can make an argument for 10 good reasons why the market will go down in 2019, but you can counter with 10 good reasons why it won't. Basically answering the concerns that I raised in the 10 reasons why I think it will go down. So those are fundamentals as opposed to charts. Number 10 was the chart. And even on the weekly, it's showing signs of turning around. So even the chart is looking better on the Dow Jones Industrial Averages. It's also looking better on stocks like Amazon, but I'm not going to show that now. I want this to be focused on the 10 reasons why the market will continue to lose in 19 and 10 reasons why it won't. This has been Dr. J at 11, streaming live from Long Island, New York. Ciao.